If you own a home in Canada, you are sitting on a tax advantage most homeowners have never been told about. The Canada Revenue Agency has a rule: mortgage interest is not tax deductible. You earn money, you pay tax on it, and then you hand the after-tax dollars to your bank as interest every single month. But here is what almost nobody in Canada knows. There is a completely legal Canada Revenue Agency approved strategy that lets you convert that non-deductible mortgage interest into fully tax-deductible investment interest. It is called the Smith Maneuver. And if you own a home in Canada and you have never heard of it, this video might be the most valuable 9 minutes you spend this year. I am going to show you exactly how it works, step by step, the specific mortgage product you need, and the real math on what this is actually worth. Before we talk strategy, we need to rewire something because every Canadian is raised with the same financial commandment: pay off your mortgage, get out of debt. Debt-free is the goal. And look, I get it. Debt feels bad. We are wired to hate it. But here is the thing the Canada Revenue Agency actually tells us, and most Canadians never read this far. The Canada Revenue Agency does not view all debt equally. They put it into two categories: bad debt and good debt. Bad debt is money you borrow for things that do not generate income: your car loan, your credit card balance from that trip to British Columbia, and yes, your mortgage, because your house does not generate taxable income. You live in it. The interest you pay on your mortgage is pure after-tax money going straight to the bank. Good debt is money you borrow to invest in something that generates income: dividend stocks, an exchange-traded fund portfolio, a rental property. Because you are trying to earn taxable income, the Canada Revenue Agency lets you deduct the interest cost from your taxes. The Smith Maneuver is a conveyor belt. Every single month, it moves a chunk of your debt from the bad pile to the good pile. You are not paying off your debt faster. You are converting it, painting it green. And stick around because at the 6-minute mark, I am going to show you the flywheel effect that lets people pay off a 25-year mortgage in 12 to 15 years. It is the part most people cannot believe is legal. Now, can you do this with your current mortgage? Probably not. Most Canadians have a standard amortizing mortgage. You make your payment, the balance goes down, the equity sits trapped inside your walls until you sell. That equity is doing nothing for you right now. To run the Smith Maneuver, you need one specific product. It is called a Readvanceable mortgage. Here is how it works. Your total borrowing limit is set at 80% of your home's value. Let us say that is $640,000. That limit is split into two parts. Part 1 is your mortgage, the amortizing loan that goes down every month. Part 2 is a home equity line of credit, a revolving credit line. In a standard setup, you would have to apply to access that equity. In a Readvanceable mortgage, these two parts are linked like a seesaw. Every time you make a mortgage payment and pay down, say, $1,500 of principal, your home equity line of credit limit automatically increases by exactly $1,500 instantly. No application, no waiting. That automatic readvanceability is the engine of this whole strategy. Without it, the friction is too high and it falls apart. The major Canadian banks, Toronto-Dominion, Royal Bank of Canada, Scotiabank, and Bank of Montreal all offer versions of this. Ask specifically for a Readvanceable mortgage, not a standard home equity line of credit, a Readvanceable mortgage. You have the product. Here is what you do every single month. Your regular mortgage payment comes out. Let us say it is $3,200. Of that, maybe $1,400 is interest going to the bank and $1,800 is actual principal paydown. That $1,800 is the number we care about. You log into your banking application. Because you have a Readvanceable mortgage, your home equity line of credit limit has automatically increased by exactly $1,800. You borrow that $1,800 from the home equity line of credit and transfer it to your checking account. This is the moment the clock starts on your tax deduction. You move that $1,800 into a non-registered investment account. And I need to be really clear here, not your tax-free savings account, not your registered retirement savings plan, a taxable non-registered account. This matters legally. You invest it, and what you buy matters. The Canada Revenue Agency requires assets with a reasonable expectation of income. That means dividend-paying stocks, exchange-traded funds that pay distributions like the mentioned examples, real estate investment trusts, rental properties, not Bitcoin, not gold bullion, income-generating assets only. At the end of the month, the home equity line of credit charges you interest on that $1,800. Let us say it is $9. You pay that $9, and because that $9 was spent to earn investment income, it is 100% tax deductible. You have just converted $1,800 of bad debt into good debt. You do this every month, 12 times a year for decades, and the numbers get very interesting very fast. Fast forward to the end of year 1. You have been doing this for 12 months. Your investment loan is now around $22,000. You have paid roughly $1,100 in home equity line of credit interest across the year. When you file your taxes, you deduct that $1,100 as an investment interest expense. If you are at a 40% marginal tax bracket, and a lot of working Canadians are in that zone, the government sends you a check for around $440. Here is where most Canadians make a mistake. They take that $440 and spend it. New hockey gear, a weekend in Niagara, gone. The Smith maneuver investor takes that $440 and makes an extra prepayment on the mortgage. Watch what happens. The mortgage drops by $440. The home equity line of credit limit rises by $440. You borrow that $440 and invest it. Next year, your deduction is slightly bigger. Your refund is slightly bigger. The prepayment is slightly bigger. This is the flywheel. The refund pays down the mortgage. The mortgage paydown creates home equity line of credit room. The home equity line of credit room creates a bigger deduction. The bigger deduction creates a bigger refund. Round and round, every year faster than the last. This is how people pay off a 25-year mortgage in 12 to 15 years while simultaneously building a 6-figure investment portfolio using the same dollars twice. Let me put a real number on this so it stops feeling abstract. Take a homeowner in Ontario with a $600,000 mortgage at 4.5% 25-year amortization and a 43% marginal tax bracket, which is pretty typical for a household earning between $100,000 and $150,000. Without the Smith maneuver, they pay off the mortgage in 25 years. Total interest paid to the bank, roughly $390,000. Investment portfolio at retirement, whatever they manage to save separately. With the Smith maneuver, running it properly with the tax refund flywheel, the mortgage is gone in approximately 13 to 15 years. Total tax refunds received over the life of the strategy between $18,000 and $24,000, and the investment portfolio built entirely from converted equity and reinvested refunds somewhere between $400,000 and $600,000 depending on market returns. Same income, same house, same mortgage, completely different financial outcome because the debt was converted instead of just paid down. That is not a small difference. That is the difference between retiring with nothing outside your home equity and retiring with $500,000 in an investment portfolio. And this is important. The Canada Revenue Agency has very specific rules here, and you need to respect them. You can only deduct the interest if the money is invested in assets with a reasonable expectation of income. Income means dividends, distributions, or rent, not capital gains. Greenlight list includes Canadian dividend stocks, broad market exchange-traded funds that pay distributions, real estate investment trusts, rental properties. Red light list includes Bitcoin, gold bullion, growth stocks that pay zero dividends. These pay no income, so the interest deduction will be denied. Do not go there. And the golden rule, no registered accounts. Do not put Smith maneuver money into your tax-free savings account or registered retirement savings plan. You cannot deduct interest on money borrowed to make tax-free income. The Canada Revenue Agency will not allow it, and you will have an uncomfortable conversation with them if you try. The risks, because this is leverage, and leverage cuts both ways. Risk 1. A home equity line of credit is a demand loan. Read your contract. The bank can technically call the loan at any time. In practice, they almost never do this as long as you are making payments. But if Canadian housing prices drop significantly and your equity evaporates, the bank can freeze your home equity line of credit. If that happens at the same time the market drops, you could be forced to sell investments at a loss. The solution to both risks is simple. Keep a cash buffer. 3 to 6 months of living expenses in a high-interest savings account like Equitable Bank. Your emergency fund is not optional when you are running leverage. It is the seatbelt for this strategy. Here is the bottom line. Every Canadian homeowner who pays mortgage interest and also invests should know this strategy exists. Whether it is right for your specific situation depends on your income, your home equity, your risk tolerance, and your discipline. But the homeowner who does not know about the Smith maneuver is handing the Canada Revenue Agency money they were never legally required to pay.